What happened over the last 12 hours was a calculated, coordinated attack on the psychology of the silver holder. In the thin, illiquid overnight Asian trading session, a massive wave of paper sell orders hit the market. They flushed the price of silver all the way down to $77 an ounce. They targeted the stop-loss orders of every retail trader who was overleveraged and sleeping. They wanted to paint a terrifying technical picture. They wanted you to wake up, see $77, panic, and sell your physical metal for digital pennies. It was a textbook stop-hunting expedition designed to break your conviction. But then the sun rose in New York, and the second the major Western trading desks opened, the exact opposite happened. A massive, relentless wave of buying pressure stepped in and ripped the price right back up. We saw a staggering $10 bounce off those overnight lows, pushing the price all the way back up to the $87 level before settling here at $84. Think about the magnitude of that move. A $10 swing in a Tier 1 monetary asset in less than 24 hours. This is not normal behavior. This is a war zone. The bullion banks are desperately trying to push the price down with paper, while the physical reality is aggressively pulling it back up. If you're just looking at the final price of $84, you're missing the entire story. The story is the violence of the swing. The story is the rejection of $77. We need to talk about exactly who stepped in and bought that dip with such ferocity, because it was not retail traders. Let's talk about the apex predators of the financial system. When silver flash crashed down to $77 in the dead of the night, retail investors were terrified. They were hitting the sell button, desperately trying to salvage what was left of their fiat accounts. But on the other side of those desperate retail sell orders were the largest, most ruthless buyers on the planet. Sovereign wealth funds, Eastern central banks, massive industrial conglomerates that manufacture the global energy grid. They look at a $77 price tag on physical silver, and they do not see a crash. They see the greatest fire sale in modern economic history. They know the structural deficit is fatal. They know the global mine supply is collapsing. So when Wall Street foolishly drops the price to hunt retail stop losses, these institutional giants step in with unlimited capital and aggressively buy the bottom. And they are not buying paper derivative contracts to flip for a quick digital profit. They are buying the suppressed paper contracts and immediately standing for physical delivery. They are pulling the actual metal right out of the comex vaults. This is exactly why the price violently snapped back $10 in the blink of an eye. The Western bullion banks tried to trigger a cascading paper sell-off, but they accidentally triggered a massive physical buying frenzy from the East. The rebound was so violent, so aggressive, that it completely blew out the short positions of the smaller algorithmic trading desks. We ripped straight back up to $87 because the physical demand simply overwhelmed the paper supply. But the war didn't end there, because we have to look at where we are sitting right now. The New York Open just pulled the price back down to $84. Why 84? Because $84 is the new line in the sand for the Wall Street short sellers. When the price rebounded to 87, the major bullion banks panicked. If silver holds above 87 and starts breaking into the 90s, their entire derivative book goes up in flames. They face margin calls that could liquidate their institutions. So they stepped in right at the New York Open, dumped another massive wave of naked short contracts onto the market, and artificially capped the rally at 84. They are desperately trying to stabilize the bleeding. They are trying to build a technical ceiling to convince you that the rally is over. But capping the price at $84 does absolutely nothing to solve their core problem, because the physical metal is already gone. The sovereign buyers already scooped it up at 77, loaded it onto cargo ships, and removed it from the Western fractional reserve system permanently. This violent $10 swing exposed the absolute fragility of the paper market, and it perfectly sets up the massive technical breakout that is coming next. We need to look at exactly what this $84 consolidation means for the next 48 hours of trading. Let's look exactly at what this $84 consolidation means for the next 48 hours of trading. Because the mainstream financial media is going to spin this entirely wrong. They're going to look at the New York Open, see the rejection at 87, and tell you that the silver rally has officially topped out. They will say the market has normalized back to $84. Do not listen to a single word of that narrative. What you're looking at on the chart right now is not a top. It is a coiled spring. It is a massive, violent volatility contraction. You have to look at the volume behind the moves. The volume that bought the dip at $77 was physical, institutional, and permanent. That metal is gone. The volume that capped the price at $84 today is pure, unbacked, digital paper. The Western bullion banks just expended an incredible, historic amount of algorithmic ammunition simply to pull the price down $3 from the daily high. They are literally emptying the clip. They are throwing every naked short contract they have left at the tape just to keep silver below $85. But they are fighting financial gravity. When you artificially compress a market that just proved it has a hard physical floor at $77, You create explosive upward pressure. Every hour that we consolidate here at 84, the physical drain continues in the background. The industrial buyers are still accumulating. The sovereign wealth funds are still loading the cargo ships. The paper short sellers are sitting on a ticking time bomb. If they lose control of this $84 level over the next 48 hours, there's absolutely no technical resistance left until we break back into the 90s. And once we cross back over that line, the margin calls will trigger a cascading short squeeze that will make today's $10 bounce look like a minor blip. They know it, and the algorithms know it. That is why the trading action right now feels so incredibly tense. It is a Mexican standoff between the physical reality of the East and the paper illusion of the West. If you're trying to day trade this chop with leveraged futures, you are walking through a minefield blindfolded. They will whip the price up and down $2 at a time just to liquidate your options. You have to understand the psychological warfare at play here. So here's the final verdict on the absolute madness we just witnessed over the last 24 hours. A $10 swing in a Tier 1 monetary asset is not a normal market correction. It is a heart attack for the fractional reserve system. When the bullion banks flushed the price down to $77 in the dead of night, they didn't trigger a mass retail capitulation. They triggered the largest institutional buying spree of the year. They handed the physical wealth of the West directly to the Eastern industrial machine on a silver platter. And artificially pulling the price back down to $84 at the New York Open is nothing but a temporary paper band-aid on a gaping, fatal wound. They are trapped, and they are using unprecedented financial violence to hide it. So what is your exact battle plan while the paper market bleeds out? You have to completely stop playing their game. If you are sitting there sweating over a $2 intraday pullback on a trading app, you're entirely too leveraged in fiat derivatives. The algorithms want you emotional. They want you trapped in their endless circle of panic and greed, constantly buying high and selling low. The only way to become truly unfettered from this broken fiat system is to step outside of the digital casino entirely. The only true safe harbor in a market this violently manipulated is the physical metal in your own hands. When you hold the physical asset, you bypass the comex completely. You do not care if the New York Open smashes the paper price down $3 because you know the structural deficit is permanent and the sovereign buyers are accumulating every single ounce they can find. You become your own central bank, completely immune to their overnight flash crashes and algorithmic stop hunts. Let the mainstream financial media try to explain away a $10 daily swing as routine volatility. Let them convince the masses that the $84 cap is the new ceiling. You have the raw data. You know exactly what a rejection at $77 means for the future of the short sellers. I want to know exactly who survived the overnight flush. I want to know who woke up, looked at the red candles on the chart, and laughed at the algorithmic manipulation. Drop a comment below right now with the exact words. I held the line. Let the algorithms read that. Let the bullion banks see that their psychological warfare is officially failing. Let the weak hands get shaken out by the New York Open. The wolves are holding the physical reality, and we are not giving them a single ounce back. Stay liquid. Stay dangerous.